Hello friends, welcome to the Manthan series of ABM. As you know, in Manthan series we are covering all the subjects of CIIB, compulsory ones, all compulsory. ABM, BFM, ABFM, BRBL. I am covering ABM and BFM. So watch all the series, complete series. Watch all the mentors. Very important previous year questions are being covered. Okay. All the recalled questions plus numericals, case studies, objective questions. Subscribe to the channel, click on the bell icon. Okay. And let's start today. Today we are dealing with term loans. Here I'll be dealing with few objective questions as well as later I'll be solving two case studies. So watch the video till the end. Share it with your friends, like the video, subscribe to the channel, click on the bell icon. Let's start. Again. Which of the following scenarios would most likely trigger a breach of positive covenant in term loan agreement? Read this. See, firstly, what is positive covenant? You need to understand that first. What is positive covenant? This positive covenant means condition. Condition. Covenant means condition and positive means positive. Simple. Good condition. Okay, so would breach likely to trigger the breach of positive covenant in term loan agreement? The borrower's debt to equity ratio increases significantly above the agreed upon threshold. The borrower sells a non-core asset with the lender's prior approval. A borrower expands into new product line as outlined in the initial business plan. The borrower repays an existing unsecured short-term loan. So most likely trigger a breach of positive covenant. Means positive covenant means whatever is a good gesture in which the bank is giving the loan. So that is going to breach that. Okay, breach that means bank will turn into a negative. This will turn into a negative aspect for the loan. So what is it? Which one is it? See, obviously this second one is not there. Selling a non-core asset has nothing to do. That borrower's its own will. I am having a house. I want to sell it. Who can stop me? A borrower expands into a new product line as outlined in the initial business plan. As outlined means it was already decided. So that is also not a negative covenant. Okay. Only these two now. A borrower's debt equity ratio increases significantly above the agreed upon threshold. What was agreed? So the borrower's debt equity ratio increases beyond that. Now see this, any ratio when it increases beyond the agreed level, obviously it is bad for the loan, isn't it? Then the borrower repays the existing unsecured short-term loan. That is also not a negative covenant. If somebody is having the money, suppose if I get a money, my uncle gave me some 2 crore rupees, I'll repay the loans, right? So this is also not a negative covenant. Only the answer is this. Breach of positive covenant, isn't it? Breach of positive means actually we are talking of negative covenant. Okay. So here borrower's debt to equity ratio increases significantly above the agreed upon threshold. What does it mean? Suppose if it moves above the given threshold, it means my debt is increasing. That is very serious, isn't it? Next. A bullet repayment structure in term loan implies. So what is bullet repayment? Let's see. Increasing installment amounts throughout the loan tenure. Varying installment amounts based on the borrower's cash flow. Repaying the entire principal amount along with the accrued interest at the maturity of the loan. Only paying interest during the loan tenure with principal repaid at the maturity. So what is bullet? Have you seen the bullet repayments in your banks? Have you seen bullet repayments? How many of you have seen this? Many a times, I'll tell you, many a times, gold loan is a bullet repayment. Many a times. It's not always. I don't say always. By rule, the person must pay the interest of the gold loan every month. but we allow, check in your bank itself. We allow like this, and at the maturity that person pays. Okay. So that is bullet. More than this is just a vague, rough example. Main is this bank-to-bank borrowings. Whenever some XYZ bank, let's say SBI, wants funds from PNB, it takes loans on the repo. Okay, based on repo, means that's called as interbank borrowing. If bank X borrows from bank Y, generally the borrowing between them is done on the bullet repayment. Means bank X will pay to bank Y at the maturity. Generally these loans are short-term loans, 3 months, okay, 3 to 4 months, max to max. That's why it is bullet repayment. So what does bullet repayment means? See this. Repaying the entire principal amount along with the accrued interest at the maturity of the loan. Okay. So complete payment is made at the end. Repaying the entire principal amount along with the accrued interest at the maturity. Okay. So that is the point. Remaining all things are different. What is this? Varying installment. These are not called as, okay. Tell me that also. B. What is the name of B? Varying installment amounts based on the borrower's cash flow. Varying installment amounts means many a times what happens, the installment is lower at the initial stage and at the later stage it is higher. So these are called as teaser. These are teaser loans. Teaser. Then increasing installment amounts throughout the loan tenure. Again, this is a form of teaser loans. Kindly note, there is a concept called as teaser loans. In teaser loans, the initial installments are lower and later they increase. Although it is not allowed for the retail loans. RBI does not allow this. It is only allowed for the restructured loans, NPS, which have been gone into rehabilitation. Only paying the interest during the loan tenure while principal repaid at the maturity. This is a term CC, isn't it? OD, cash credit. Right? Got this point? So, the answer for bullet was repaying the entire principal amount along with the accrued interest at the maturity. In context of term loans, what is the question? In context of term loan, collateral, which of the following statements regarding the distinction between primary and collateral security is most accurate? Means, basically the question is, what is the difference between primary security and collateral security? Basic logic. The primary security is typically a personal guarantee while collateral is a tangible asset. Okay. Primary security is the asset for which the loan is taken, while collateral is the additional security offered. Collateral security is always held at the borrower's, in the borrower's name, while primary is held by the bank. There is no functional difference between primary and collateral security. So what is the difference between primary and collateral? Everyone. What is the difference between primary and collateral? Suppose if I am taking a home loan, I give that home on a mortgage. What is that home loan? Home. So that is my primary security. Primary, right? I am taking the loan for the home, building the home. And then I am giving that home only as a security. So that is known as primary. So primary security always, this is the answer, B1, is the asset for which the loan is taken. If I take a car loan, then car is a primary security. Okay. Now CC, if I am taking CC, what is my primary security in CC? Everyone answer me. What is the primary security in CC? Cash credit. Primary security in CC is stock and debtors, right? But what is the collateral? I can take anything collateral, the house of that customer mortgaged, or some car, or some any fixed asset. Collateral means which is already existing. That person is just giving me the existing property as a collateral to me. Okay? Got it? So that is the main difference. A term loan facility structured as syndicated lending offers which primary benefit to the lenders. So syndicated loans. What is syndicated loan? See, there is something called as consortium financing. Consortium means what? 2 to 3 banks. Bank A, B and C. Let's say, example, I am taking 3 banks. They come together and finance to some customer X. Okay. So all the 3 together finance it. That's called as consortium. Consortium is of the types called as syndication and participation. So that is syndication. Okay. Here all the banks come together. One bank is the lead bank that takes the lead and does all the paperwork. Okay. So now the term loan facility structured as syndicated lending offers which of the primary benefit to the lenders? Centralized decision making and reduced administrative burden, the ability to provide smaller loans to larger number of borrowers, the opportunity to specialize in a specific type of lending without sharing the risk, spreading the risk of lending a large sum of money across multiple financial institutions. So what is the best answer for this? Syndicated. Centralized decision making and reduce administrative burden. That is not the point. Centralized decision making, it has nothing to do with this. Syndicated. Okay. Ability to provide smaller loans. That is the retail loan to large number of borrowers. That is the retail loan. Okay. So this is also out. The opportunity to specialize in specific types of lending without sharing the risk. That is not possible at all. Without sharing the risk, you can't have a loan. Simple. Okay. So only answer is this. Spreading the risk of lending a large sum of money across multiple banks or multiple financial institutions. Obviously, no? Suppose if I am Reliance, if this is Reliance, let's say, and this Reliance says that I want a funding of, let's say, 1000 CR. Now 1000 CR is very difficult for any single bank to handle. Tomorrow if something happens, then the whole bank is in trouble, isn't it? That's why banks generally distribute this. That's called a syndicated. Okay. Which statement regarding the term loan amortization schedules and interest calculation is generally true in the initial stages of a typical amortizing term loan? So what is true in the initial stages of any term loan? Kindly note. Basic question is, in the initial stages, what is true? Simple. Remaining all sentences okay. What is true in the initial stages of the loan? Read. A large portion of the EMI goes towards the principal repayment while small portion towards the interest. Interest component of the EMI is significantly higher than the principal component. Both the interest and the principal components are equally distributed throughout the loan tenure. The principal repayment component starts low and increases over time while interest component starts high and decreases. Yeah. The answer? In fact, I'll give multiple answers can also be true over here. Now tell me, multiple answers can be true. See, large portion of EMI goes towards principal. Wrong. Okay. Interest component of the EMI is significantly higher, right? In the initial stages. Check your home loan amortization schedule. You will see that the interest component of the loan is higher in the initial stages. Later stages, the principal component is higher. So B is true. C is out, equally distributed. Principal repayment component starts low and increases over time, while the interest component starts high and decreases over time. Both B and D are true. Both B and D are true over here. Got it? Both B and D are true. Got it, everyone? Clear? Next. A negative covenant in term loan agreement would most likely restrict the... So what is the negative covenant? Negative means what? Some negative condition. You can't do this. You can't do that. So what would it restrict? Paying regular dividends to the shareholders. Can a bank say that I have given a loan to Reliance? Now Reliance, you will not pay any dividend. What is the bank to do with it? As far as your EMIs are getting, if you are getting the EMIs properly, you can say anything over there. Entering into a new loan, new term loan debt without lender consent. Yeah, that is the point. Negative covenant. You can't enter. right? If I'm having a loan with somebody, I can't say that I'll take a new loan without the consent of the, see, if I take the consent, then it's okay. Maintaining accurate financial records, negative. It's actually positive, isn't it? Adhering to the environmental guidelines, positive. These are all positive covenants. These are not negative covenants. In term loan context, mezzanine financing can be best described as. So what is mezzanine financing? How do you describe mezzanine financing? Read this. A short-term unsecured loan provided for working capital needs. Pure equity investment with no debt component. A hybrid financing instrument that combines features of both debt and equity. A senior secured loan with lowest risk profile. So what is mezzanine? Think everyone, think. The answer is, it's a hybrid component. It's a mixture of equity and debt. That is called as mezzanine financing. Kindly note this. Again, if a borrower prepays a term loan with a fixed interest rate, which of the following is most likely to be the consequence for the lender? For the lender, say, if there is a borrower, home loan generally this happens. The customer comes and repays the full amount. So what is the effect of that repayment on the lender? The lender will earn more interest than initially projected. The lender might impose prepayment penalty to compensate for the lost future interest income. The lender's overall risk exposure for that loan will increase. The lender will automatically offer a lower interest rate on the remaining loan. Is it so? Think. What is the answer over here? Yeah, the answer is lost interest. Because see, if I prepay any loan, obviously that is a loss to the bank, isn't it? Then the whole interest which they are expecting for the future, they are not getting it, isn't it? So that is the answer. You take a loan of 5 lakhs on an annual interest. Now this is a numerical. Annual interest of 6% for a tenure of 5 years. Calculate the yearly installment. Yearly installment you have to find out. Very simple. Which formula will you use? Ordinary annuity. Ordinary annuity repayment formula. So you want to find out the installment. Okay, installment, EMI. What is the formula for EMI? EMI formula is, anyone? What is the formula for EMI? See, EMI equals to, firstly remember, it is the ordinary annuity formula, just it is reversed here and there. Okay, so EMI equals to loan into loan. Kindly note this formula, into R into 1 plus R raised to n, the whole upon 1 plus R raised to n minus 1. So EMI equals to loan into R into 1 plus R raised to n minus upon 1 plus R raised to n minus 1. So loan amount, do you know? Yes, you know, 5 lakhs. Write this, 5 lakhs into, now what is R? Rate of interest is given as 6%. Okay. So 6 means, percent means you will take it 0.06. This you will take it 0.06 divided by 100. Okay. So 0.06 into, now this 1 plus R raised to n. So what is 1 plus R? 1.06. Pay attention. 1.06. Isn't it? Directly we'll do it. So 1.06 raised to n. What is n? 5 years? 5. The whole upon 1.06 raised to 5 minus 1. That only, no? Yeah. See this? Is everyone getting this? Is everyone getting whatever we are doing over here? Is everyone with me or somewhere else? Now solve this. Okay? Solve this. First, find out, very first step, find out 1.06 raised to 5. Type 1.06, then into equal to 5 times. Okay? 1.06, then type into equal to 5 times. Okay? Clear everyone? So 1.06 raised to what? 5? Yeah. So 1.338. Okay, it is 1.338. So first write it down. This figure is very important. Remaining everything you can do it. 1.338. Write this down. This figure is very important. Now solve this. Solve it now. So numerator 1.338 into what is this? 0.06. 0.06. So what is the numerator? 0.08. See, I am also doing it live over here. Okay, you also do it live. Everyone give me the answer. Numerator is what? It is 0.08. 0.08. 02 is also there. Leave it. Just take 2 digits. Now denominator 1.338 minus 1. So it is directly 0.338. So divide this. 0.08 divided by 0.08 divided by what is this? 0.338. So that is equal to 0.23. So this answer is 5 lakhs into 0.23 and something more. So let's keep it only 0.23, or you can take it 0.24 also because it is 0.27. So you can take this 0.24 instead of 3, make it 4. Okay. So now multiply this. 5 lakhs into 0.24 into 5 lakhs. 5 lakhs means 5 zeros. Right. So it is, what is the yearly installment? It is 118,777 roughly. 118,777. This much is roughly the installment. You might get here and there some figure. That's okay. It depends on what digits you take, isn't it? So you can take any, means any, up to 2 also, up to 4 also. Even up to 2, nothing happens. Means nothing much changes in this. Okay. Got this point? So now, before going, everyone, kindly note the new batches of Adda 24/7 have just started. They are in the starting stage as of now. Join them ASAP. While joining, kindly note, join the batches through the app. First download the app and then join. First download the app. Okay. Available on both Play Store and iPhone also. So download it. Then go to JAIIB and CAIIB. Look at this. You can get directly here also CAIIB Mahapack and Pro Batch. See this CAIIB Officers Pro Batch. All the numericals, objective questions, case studies, everything is covered. Ebooks, mock test are to the level of chapter wise as well as full length also. Ebooks also, chapter wise you are getting. Okay, you can click on this and get it. See, all these things you get it. Everything is available. So go for it right now. Also you can go for the what is the discount offer? See, this discount offer is right now 81%. 5432. Okay. 80% discount plus 1% through the app, 81%. Also, you can join this Increment Mahapack. Okay. Increment CAIIB Increment Mahapack. See this. Here you are getting right now double validity. You buy for 6 months, you get it for 12 months. Plus, you are getting 15 plus batches per subject. Plus 81% discount. Everything is plus. But for that, you will have to use the code Y432. Y432. Never forget this code. Y432. 80% plus 1% through the app plus 12 month double